we'll be doing a FAR, and for today we'll be doing employment benefits. That's IAS 19. That's our session for today. Employee benefits. That's IAS 19. To start with, what's employee benefits? Now, employee benefits, they are just all form of consideration given by an entity to an employee for the services rendered. So any form of consideration you get from the employment, that's what you call employee benefits. For example, from your employment, you get salary, you get commission, bonuses, also allowances. They are part of employee benefits. And the objective of IAS 19 is to provide the accounting and the disclosure requirement when accounting for employee benefits. Another thing also you need to know that IAS 19 has also provided the major classification or types of employee benefits, of which they are majorly classified into three. Actually, there are more than three, but majorly they are classified into three. One of the type of the employee benefits, we have what we call termination benefits. And for the termination benefit, they are benefits which will be payable upon work being terminated, either by the employer or by the employee. That's what we call termination benefits. Or what we, as an example, we have what we call severance fee. That's termination benefits. Then another type of employee benefits, we have what we call short-term employee benefits. Now, for the short-term employee benefits, there are benefits which are payable within a duration of 12 months or within a duration of 1 year. For example, we have salaries. Also, we have commission, allowances. All of them, they are part of short-term employee benefits. Then another classification, we have what we call retirement benefits, or what we call post-employment or the pension. That's another classification. In that case, they are the benefits which are payable upon retirement. That's what we call post-employment benefits. So that's for today. Now let's go, we do some computation and we write something. So we are doing employee benefits. So it's benefits. IAS 19. And you'll see that employee benefits, they are just all form of consideration. They are all forms of consideration given by an entity in exchange for the services rendered by employees. Good. And then what are the major classification or type of employee benefits? Types of employee benefits. So number one, we have termination benefit. Termination benefits. Then number two, we also have short-term employee benefits. And number three, we have post-employment, or also we call it retirement benefits. Yeah, we call it also retirement benefits. Retirement benefits or the pensions. Yeah, those are the major. And also we can also say long-term employee benefits. So what's the difference? The difference is that for the termination benefits, we are saying that they are the benefits which will be payable upon work being terminated by either the employee or the employer. So that's the termination benefit. Then we have short-term employee benefits. They are benefits which are payable within 1 financial year or within 12 months. So e.g., we have salary, also we have commissions, allowances, yeah, etc. So that's the short-term employee benefits. Then we have post-employment or retirement benefits. Now, for the post-employment benefits, they are the benefits which will be payable upon retirement, which will be payable upon retirement. And then also we have long-term employee benefits. Now, for the long-term employee benefits, they are the benefit. They include benefits not settled within 12 months, such as what we call sabbatical leaves. Do you know what are sabbatical leaves? You have sabbatical leaves or long-term service benefits. Yeah. So in this case, I want us to focus more on the post-employment. Post-employment or the retirement benefits. Retirement benefits. And we have said that they are the benefits which are payable upon retirement. And we have said they are also known as the pension. So, and this is an arrangement by which an entity will provide pension to the employees after they retire. So, and an entity should recognize contribution to the defined plan scheme as an expense. I'll come to show you how to account for that. Yeah. And there are two types of pension plans. So the retirement benefits, we have, let's look at types of pension plans. And they are classified into two. We have two types. Number one, we have defined contribution plan. Number two, we also have defined benefit plan. Those are the two types of pension plan. And the difference is that now, for the defined contribution plan, the pension payable upon retirement will depend on the amount of contribution made by either by both employee and employer during their career life. So in this case, I'm saying that for the defined contribution on retirement, the pension payable on retirement will usually depend on the contribution paid into the plan by the employee and the employer. And also in this case, the employee will bear the uncertainties of the amount which will be paid upon retirement. So this is what I mean. Assuming during your career life, you contributed like 3 million. Now, if you after you retire, the pension plan will not pay you 3 million. That's why you are saying that the employee bears the uncertainties of the amount receivable upon retirement. Why? Because if you had contributed 3 million, you get more than, upon retirement, you get more than 3 million. Now, this more than or this extra, let's call it a bonus, will depend on the performance of the investment. Now, what the pension plan usually does, like in NSSF, the amount you contribute, they do invest them. They invest in diversified portfolio. And if they invest there, since it's an investment, they expect to get a return. Now, this return they get, remember they are getting return which they had invested using your money. So that means that return they also have to share with you. So, and that sharing, wanaweka hapo, so that one will make that plus, an extra 3 million plus. So, and that extra will now determine, or this, that's why you're saying that that uncertainty will be there because this bonus or the amount to be received or that return will depend on the performance of the investment. If the investment performance was good, the higher the benefits. If the investment was lower, the lower the benefits. So now that's what you call defined contribution plan. Another type of pension plan we have is the defined benefits plan. And for the defined benefits plan, the pension payable on retirement under this plan will depend either on the final salary or the average salary during career life. So we have said that under this scheme, the pension payable on retirement under this plan will depend on either the final salary or the average salary of the employee during the career. And this calculation will be based on what we call the actuarial assumptions. So the calculation will depend on the actuarial assumptions. And for actuarial assumption, we have two major actuarial assumptions. We have demographic, we have what we call demographic, and also we have financial assumption. Now, for the demographic assumption, they relate to things to do with future characteristic of an employee. Those are demographic assumptions. They'll depend on the assumption which are about the future characteristic of the employee, such as the mortality rate during and after the employment, also rate of employment turnover, also claim rate under medical plans. So that's under demographic assumptions. And also, so that's demographic assumptions. Then we also have financial assumptions. For their financial assumptions, they deal with items such as, we can talk about the discount rate. Also, we can talk about the future salary at the benefits level. Also, we can talk about the expected rate of return, etc. So now, after now you have differentiated between the two, the type of pension plans where we have the defined contribution plan and the defined benefits plan. Now, we need to know, now we need to show you how do we account for them, or how do we measure defined pension asset and defined pension liability. So I want to have this. For those who have, you can screenshot. For those who are taking screenshotting. Now we look on how do we measure defined pension assets and defined pension liabilities. So measuring defined plan assets and liabilities. So now when measuring the defined plan asset and liability, both defined asset and liability outstanding at the beginning of the period, of the outstanding at the beginning of the reporting period, will be reconciled with the amount outstanding at the end of the period. And how do we measure them? So when measuring them, so let me start with defined plan asset. Defined plan asset. And this is how we measure the defined for defined plan asset. You start by getting the fair value of plan assets balance brought down. Then you add the contribution to the plan, contributions to the plan. And also you add return on plan asset. Return on plan asset. Then you deduct the amount of benefits paid. What you get there, we can call it the carrying amount. Now, then you compare the carrying amount against the fair value balance carried down. You'll be provided with the fair value of the balance carried down. Now, the difference between the two, that's the difference between the carrying amount and the fair value balance carried down. That difference there is what we call actuarial gain or actuarial losses, or they're also known as measurement changes. So we are saying it's either an actuarial gain or it can be actuarial losses. And there's also another term, they're also known as remeasurement. Remeasurement changes. Yeah, either actuarial gain or actuarial loss. And tumesema to get the actuarial gain or actuarial loss, you just get the difference between the carrying amount and the fair value balance carried down. Number 2, how do we measure defined plan liability? This is how we measure defined plan liability. So you start with the present value balance brought down. Then you add, for the liability, we add the expenses. And in this case, we have the current service cost. Also, we have past service cost. Also, we have the interest or the finance cost, the interest cost. And then you rest the amount of benefits paid. Benefits paid. What you get there, that's your carrying amount. Then you'll compare the carrying amount against the present value balance carried down. So you'll already be provided with this. So now the difference between the carrying amount and the present value balance carried down, that difference, it's also either actuarial gain or it can be actuarial loss. Good. So we are talking about, you see, in this case, we are talking about liability. So if you ask about the present value, it's present value of that liability and the present value of that liability. It's either liability of the obligation. So that's what we refer as the present value. So those are the format. And for the format, if you want to get this corrected, you have to be, they have to be at your fingertips. Just get the format on how do we measure defined plan assets, on how do we measure defined plan liability. Good. So now with that, let's discuss also what we call multi-employer plan. What's a multi-employer plan? Now for the multi-employer plan, in this case, this where the small entity do not have resources to run a pension plan in-house. Therefore, it pays pension contribution of an insurance company or another just company which runs a multi-employer. That is pension plan for several employers. Like NSSF, it's part of multi-employer plans because they collect contribution from several employers. Then we also have what we call funded scheme and unfunded scheme. So first of all, you have to understand what we call funding, or what we refer to as funding. Now, the funding is just the process of making cash payment to a pension scheme so as to meet future obligation of paying retirement benefits. And then we have funded scheme and unfunded scheme. What's the difference? Now, for the funded scheme is a plan in which the employer transfer contribution to an external entity, which is separate and distinct from the employer. That's what you call funded scheme. So for example, in your organization, you'll be making some contribution to another scheme, a retirement scheme. So that's what you call funded scheme. In that case, the entity does not maintain. They are making contribution to an external entity. But for unfunded scheme, now for the unfunded scheme is usually mostly run by most of the big corporations. The big corporations such as Safaricom, you also have Equity Bank and the insurance company. So what they usually do, that employee benefits, they have set up a department for retirement scheme. So in that case, the amount they are supposed to transfer to the retirement benefits, they just maintain it in their organization and they reinvest it. So in that case, okay, we can say that this where the contributions are not transferred to an external entity. Rather, they are retained in the company and reinvested in the business. And mostly we have said that unfunded scheme is mostly found in the big organization. For example, insurance companies and the banks. Good. So that's the difference between the funded and unfunded scheme. Funded scheme, you make contribution to an external entity, but for unfunded, you don't transfer. You just maintain them and you retain and you invest them. Yeah. Then you have funded and unfunded scheme. So that one, go through it. So now I want us to go back on how do we measure defined plan asset and defined liability. So I want us to do an illustration. I want us to try an illustration there on how do we measure assets and how do we measure liability. So let's do the illustration one. Yeah, that question. So Viwanda Industry Limited operates a defined post-employment plan for its employees. The company actuaries has provided the following information. So we have present value of obligation as at that 1st October 2017. Fair value of plan assets as at that 1st October 2017. Current service cost for the year. Past service cost. Then we also have contribution made during the year, benefits paid to the employee during the year, present value of obligation as at that 1st October 2018. That's the balance carried down. And also you have the fair value of plan asset as at that 1st October 2018. Additional information. The expected return on plan assets as at 1st November 2017 was 12%. The discount rate for the plan liability was 10%. Required. Determine the actuarial changes for both asset and liability. Now, these actuarial changes is the actuarial gain and actuarial losses. So how do we determine that? So the format should be at your fingertips. So what you need to know there, you just need to know the format. So let's present that. So first of all, let me give you the format again. So first of all, we determine for defined plan asset. So that for the defined plan asset, you start with the fair value balance brought down. Then you add, number one, is the contribution to the plan, and also you add return on plan asset. And then you raise the amount of benefits paid so that you can get your carrying amount. Then you compare a carrying amount against the fair value balance carried down. Then you also need to determine for defined plan liability. Now for the defined plan liability, you take the present value of obligation balance brought down, then you add three types of expenses. One was the current service cost, past service cost, and the interest cost. Then you raise benefits paid. Then you can compare, then you have your carrying amount. And then you compare your carrying amount against the present value balance carried down. So we have the question there. So you have present value of obligation as at that 1st October 2017. Now that's the present value of liability balance brought down. So present value of balance brought down for the obligation, we are given it's 1,500. Then also we have fair value of plan asset, that 1st October 2017. Still it's 1,500. That's the fair value of the asset. So the fair value of the asset you also given was 15. Then you are given current service cost for the year was 160 and the part service cost was 10. So we have current service cost, we are given as 160 and the past service cost is 10. Contribution made during the year was 85. Where do we take contribution made? Contribution made, you bring it here. Contribution made for the year was 85. Then you also have benefits paid to employee during the year was 125. Now, benefits paid 125, we say that you raise benefits paid. So you deduct 125, as well as for the liability, you raise also benefits paid 125. So you deduct both from the asset and the liability. Then we have present value of obligation as at that 1st October 2018, 1750. Now, that's the present value of liability balance carried down was 1750. And the fair value of the plan asset as at that 1st October 2018 was 1650. So that's the fair value of asset balance carried down. So the balance carried down for the assets, we are given it's 1650. And also, the present value balance carried down for the liability for the obligation, we are given as 1750. Like that. Then let's go to additional information. Additional information number 1, the expected return on plan asset as at 1st November 2017 was 12%. So the expected return on plan asset was 12%. So return on plan asset, you'll take 12% of the balance brought down, the amount outstanding at the beginning of the year, which was 1,500. So it's 12% of 1,500. So that one is an amount of 180. So you get your carrying amount there. So you take 1,500, 85, 180, then you raise 125. In that case, you will have 1,640. Let's go to note number 2. Additional information number 2, you're told that the discount rate for the plan liability was 10%. So that's the discount. So this is what you do. You take 10%. Yeah, here we have the interest cost. For the interest cost, you are told is 10%. That was for the liability. You take 10% of the balance brought down, which was 1,500, and you get 150. And then you can get the carrying amount. You take 1,500 plus 160 plus 10 plus 150 minus 125. And the carrying amount you get will be 1,695. Yeah, 1,695. Now, we want to determine the actuarial changes, either actuarial gain or actuarial loss. Let's start with the plan assets. Tuangalia hapa. The carrying amount is 1,640. But you are given the fair value or the market value at the end of the year, it's 1,650. So you can see there is a change. There is an increase by 10. Now, this 10 is what we call actuarial gain. So for the asset, since the asset has an increase from 1,640 to 1,650, that 10 is the actuarial gain. Then we have liability here. The carrying amount is 1,695. You compare 1,695 against the present value balance carried down. You see we have a change here. Imetoka 1,695 and at the end of the year it's 1,750. There is an increase by 55. An increase by 55. Now, what is that? So give me your answers. So what's that? So now that's what we call actuarial losses. You see, in this case, we are dealing with the liability. Liability has increased. An increase of liability from 1,695 to 1,750. So that's an actuarial loss. So that means to the statement of financial, to the income statement, how much will you take? So you get net actuarial changes. For the net actuarial changes, from the asset, we have a gain of 10. So itakuwa 10, but we have an actuarial loss here, 55. You minus 55. And you have a loss of 45. And this 45, we usually take it as part of other comprehensive income. That's under the income statement. To the balance sheet, this one you take it as part of reserves. Yeah, you need to note that. That the net actuarial loss, if you're told to present the income statement, the net actuarial changes, you take it to the other comprehensive income, but you take it as a negative. And also, when presenting the statement of financial position, you take it as part of reserves. Good. So that's all. That's what the examiner wanted there. Yeah, you see required. Determine the actuarial changes for both asset and liability. So we are through with that. So sometimes an examiner can tell you, you present or you show the statement or the statement of financial position extract. How can you extract statement of financial position from now this? You see, this one is not a financial statement. This one usually goes to what we call notes to the financial statement. This is part of the notes to the financial statement. In case the examiner tells you to provide an extract of the financial statement, how do you provide that? I want to show you. So, for example, if you're told to provide to show an income statement extract, income statement extract, it's all about determining which goes to the income, which goes to the expenses. So under the income, an income can only come from the asset, not liability. Kwa hivyo unakuja hapa. You see this return on planned asset, it's part of income. So here you show a return on asset. Here we have a return on asset on amount of 180. Then you go to the expenses. And we get expenses from liability. So now from the liability here, we have 3 expenses. We said we had 3 expenses. We have the current service cost, we have the part service cost, and we have the interest cost. So under expenses, you bring the current service cost, also we have the past service cost, and then we have actuarial, sorry, not actuarial, but yes, talking about the interest cost. And the current service cost was 160. Past service cost was 10, and their interest cost was 150. 10, and this is 150. And then unaenda kule chini kabisa under other comprehensive income. Remember, you're showing the extract, usichukue minus C. Or you can just do this. If you take 180, then you minus 160, utoe 10, utoe 150. What you get there, in terms of the net pension cost. Net pension cost. But when providing, if you are preparing extract of the financial statement, you don't have to show this. Just show that one under income, and then watch is equal expenses. Then kule chini under other comprehensive incomes, you show actuarial loss. So in our case, remember you had an actuarial loss of 45. It's an actuarial gain of 10 minus there was an actuarial loss of 55. So you have actuarial loss of 45, like that. So that's how you show the income statement extract. What about statement of financial position? Now, for the statement of financial position, you start with the assets, non-current asset. At a non-current asset, you bring defined plan asset. Tukuje hapa. You see, at a defined plan asset, you take the balance at the end, the fair value balance carried down, which was 1650. So you bring 1650. Then you go to equity and liabilities. Under the equity, as part of reserve, you bring actuarial changes. And remember, actuarial changes was an actuarial loss. You show 45, which is a negative. This one here. And then under non-current liability, you bring defined plan liability. defined plan liability. For the defined plan liability, you come here to define plan liability. You show the present value balance carried down, and our carried down you are given as 1750. Now the balance carried down, that's what you present to the statement of financial position. So here you show 1750. So that's how you prepare an extract of both the income statement and the statement of financial position when accounting for employee benefits. So now allow me to try another illustration. I want us to do another illustration. So let's do that question number 2. The following information was extracted from the book of Comfort Retirement Benefit Scheme for the year ended that 1st October 2016 and 2017. So we have average remaining service life in years, fair value of plan asset as at 1st November. We have the present value of obligation as at 1st November, current service cost, contribution to the plan, benefits paid, past service cost, discount rate, expected rate of return on plan asset. Additional information. As at 1st November 2015, the present value for both plan assets and liability were 100 million each required, actuarial gain or losses. So in this case, we are supposed to prepare. You see, you are given 2 years. We have 2016 and we have 2017. So the format does not change. So number 1, defined plan asset. Defined plan asset. So you start with the fair value balance brought down. Then you add contribution to the plan. Then also you add a return on plan asset. Then you raise the amount of benefits paid, so that now we can have our carrying amount. Then you compare your carrying amount against fair value balance carried down. Let's go to number 2. We determine defined plan liability. So here we start with the present value balance brought down. Then you add the expenses. You start with the current service cost. We have past service cost, and then the interest cost. Then you minus, you raise the amount of benefits paid. What you have there, you have your carrying amount. And then you compare your carrying amount against the present value balance carried down. And then we have 2 years. So we have 2016 and we have 2017. 2016, 2017. 2016, 2017. So you're given the average remaining service life. Then also you are given the fair value of plan asset as at 1st November. Then you have the present value of plan obligation. Now, in this case, for example, the fair value of plan asset 1st November, is that the balance brought down or is that balance carried down? Then you are given the current service cost, contribution to the plan. We have the benefits paid. Then we have the past service cost, and we have the discount rate and the expected rate of return. So how do we show that? How do we present that? So now, for the fair value of plan asset 1st November. Now, in that case, that's our balance carried down, not balance brought down. Because you see, we are told that for the year here, for the year ended 31st October 2016 and 2017. So the year ends on 2016 and 2017. And that's what you are given here as at 1st November 2016 and 2017. Those are the balance carried down. What about the balance brought down? How do we get the balance brought down? Let's go to the additional information number 1. As at 1st November, you see, the year starts. If the year ends on October, that means the financial year starts on November. For 2016, it started on 1st November 2015. For 2017, the financial year started on 1st November 2016. So, additional information number 1. As at 1st November 2015, the present value for both planned asset and liability were 100 million each. So the fair value balance brought down equal 100, and also for the liability, the balance brought down was also 100. They were 100 each. Then we have the fair value of planned asset 1st November 96 110. Hizo tumesema ni balance carried down. So here we have 96 and here we have 110. Then present value of plan obligation liability, we have 100 and 125. Those are still the balance carried down. So 100 and we have 125. Current service cost 8 and 10. That's the current service cost. We have 8, we have 10. Then we have contribution to the plan 9 and 11. Those are the contribution. Contribution 9 and we have 11 there. Then we have benefits paid 15, 12. Benefits paid. So we said we raise benefits paid 15, 12. We deduct from the assets and from the liability. Also, for liability, we raise the benefits paid 15 and also we raise 12. Then we have past service cost 4 dash. Past service cost for and a dash there. Discount rate 10%, 8%. That's discount rate. So it's 10 and 8. So unakuja kwa interest cost. You take 10% of the balance brought down. For 2016, the rate is 10%. You'll take 10% of the balance brought down, which was 100. For 2017, we are given 8% of the balance brought down. Now, in this case, I want a balance brought down, but you have to think. Remember that the balance carried down of 2016, ndio itakuwa opening balance of 2017. So this 96 will be our opening balance there. For the liability, the balance carried down for year 2016 will be our opening balance, the opening balance for 2017, which is 100. So for the discount cost for 2017 is 8%. So you'll take 8% of the balance brought down, which is still 100. And here you get 10. 8% of 100, it's 8. Then, tukuje hapa. So we are here. Expected rate of return on plan asset. So for plan asset, we have 12% and 10%. Those are the expected return on plan asset, 12%, 10%. So return on plan asset, so utachukua 12% of the balance brought down, which is 100. And for 2017, the rate was 10% of the balance brought down. In this case is 96. So 12% of 100, that's 12. And 10% of 96, that's 9.6. Now you can determine your carrying amount. So here it will be 100 plus 9 plus 12 minus 15, and you'll get 106. 96 plus 11 plus 9.6 minus 12, you get 104.6. So now let's get the actuarial changes there. Actuarial changes. It can either be an actuarial gain or actuarial loss. Now this is how you argue. The carrying amount for 2016 for the asset is 106, but you are told that the balance of the fair value at the end is 96. So from 106 to 96, there is a decrease by 10. Asset decrease, that one is an actuarial loss. You can show it like that. Then for 2017, it has moved from 104.6 to 110. So there is an increase there by 5.4. So that increase is actuarial gain. Let's go to the liability. First of all, you get the carrying amount there. So it's 100 plus 8 plus 4 plus 10 minus 15. And you get a carrying amount of 107. For 2017, 100 plus 10 plus 8 minus 12, you'll get 106. Then we determine our actuarial changes. So for 2016, now in this case, we are evaluating a liability. So the carrying amount was 107, but the balance at the end is 100. So you can see there is a reduction by 7. For the liability can reduce, that one is an actuarial gain. Then for 2017, carrying amount is 106, and the balance at the end is 125. So there is an increase from 106 to 125. That's an increase by 19. Increase in liability, it's a loss. That's what we call an actuarial loss. And that's what the examiner wanted. Hope we are good up to that point. Good. So now I want us to move to another part. on how to accounting and reporting by retirement benefits. So how do the pension plans prepare their financial statement? How do they determine their profit? How do they determine their loss? So I want to show you how to prepare those accounts. So it's accounting and reporting by pension plans. And this one is provided by this is IAS 26. It's the one which provides for accounting and reporting by the pension plans. Now, for the pension plans, they usually prepare major two sets of financial statements. One, those are the statement prepared, is a statement of changes, statement of changes in net asset. And the other one is a statement of net assets. Yeah. Now, statement of changes in net asset. This is more of the income statement. Is the income the statement prepared to determine either the gain or loss or the surplus or the deficit for the period. And the statement of net asset, this one is the statement of financial position. So how do they determine the statement of changes in equity, and how do they determine the statement of net asset? Now, we're determining the statement of changes in net asset. Being the income statement, you have to determine what are the incomes or what are the major sources of income for the pension plan, and what are the major sources of expense. So I want to give you the format there. Yeah, how do they prepare the income statement? How do they prepare the statement of net asset? So we start with the income, with the statement of net asset. It's also known as the fund account. And this is the format. Their major sources of income are the contribution made. The contribution made by both the employer and the employee. Then we have transfer from other scheme. And then the investment income. Those are the sums of the some of the major income by the pension plans. Then to the expenses, the major source of expense are the pension and the benefits paid. So to the expenses, we have pension and other benefits. Also, you have administrative expenses, transfer to other scheme. Then we have other expenses. And then, so then they can report either the surplus or the deficit. Yeah, that's the format for the income statement or the statement of changes in net asset. How do they prepare the statement of net asset? That one is equivalent to the statement of financial position. And this is how they prepare. To the assets, you start with an non-current asset, such as investment. We have PPE. Then you go to the current assets. To the current assets, you bring the contribution or the receivables, cash at bank. We have contribution due in days. Then you deduct directly current liabilities. And for the current liability, we have pension payables. We have accruals. Then you get the net asset. So this one, the format is totally different from the statement of financial position. In this case, we are taking non-current assets, you add current assets, you raise current liability to get the net asset. And then you bring the equity funded by, you bring the fund balance or the accumulated fund, and then you add the surplus. So that's how they present those statements. So you can have a look at them before we try an illustration. So I want us to try a question that is in June 2011, question 3C. June 2011, question 3C. Yeah. So let's try that question. June 2011, question 3C. So the foreign trial balance was extracted from the books of Juhudi Retirement Benefit Scheme as at that 1st March 2011. So we have accumulated fund. Now the accumulated fund will act as our capital. That's our capital. Then we have accrued expenses. That's a liability. Administrative expense. It's an expense. Demand deposit. That one is an asset. Demand deposit is more of cash and bank balances. Then we have reduction in market value of investment. That's an expense. Commutation and lump sum retirement benefits. So tulisema all the lump sum or all the benefits paid, they are their expenses. So that commutation and lump sum retirement benefit, it's an expense. Contribution due within 30 days. Tumesema contribution is an income, but this is an income receivable within 30 days. So that one is a current asset. It's part of receivable, amount receivable within 30 days. So that one is an asset. Employer's normal contribution, that's an income. Employer's additional contribution, it's another income. Individual transfer from other scheme. If you transfer from, that's an inflow. So that one is an income. Then we have individual transfer to other scheme. To other scheme, that one is an expense. Investment income is an income. Investment property, that one is an asset. Fixed income investment, that one is an asset. All the investment, they are part of assets. Members' normal contribution is an income. Members' voluntary contribution is another income. Pension paid is an expense. Then we have equity investment, both in quoted and unquoted. So now equity investment, they are all the investment, they are part of assets. So equity investment, they are assets. And we have equity investment in quoted and which one are quoted. Now equity investment is where you are investing in shares. Of quoted, you are investing in shares of a public company. Equity investment in which are unquoted, you are investing in shares of private companies. That's the difference between the quoted and unquoted. Quoted is investment in share of a public company, and quoted equity investment is investment in shares of private companies. Then we have unpaid benefits. Unpaid benefits, hiyo ni liability, hiyo ni payables. Required. Required, number one, is the statement of changes in net asset and the statement of net asset as at that 1st March 2011. So I've already differentiated the income, the expenses, the assets, and the liability. So now we are remaining with only presenting. So let's present that. We start with A, the statement of of changes in net asset. So this was Juhudi Retirement. Juhudi Retirement Scheme. Statement of changes in net assets for the year ended that 1st March 2011. So on the side of incomes, and also we had expenses. Under the incomes, one of the income we have employers' normal contribution. An amount of 1504. Also, we had employers' additional contribution. An amount of 320. Also, we have individual transfer from other scheme. From other schemes. It's an amount of 157.5. Also had investment income. Investment income is 2370. Members' normal contribution. It was an amount of 912. And also we have members' voluntary. Members' voluntary contributions, which was an amount of 228. Go to the side of expenses. To the expenses, we had admin expenses, amount of 142. We had a reduction in market value of investment. You need depreciation, reduction in the market value of investment. It's an amount of 1132. We have commutation and lump sum retirement paid. Commutation and lump sum benefits paid, amount of 241. Also, we had transfer to other scheme, individual transfer to other scheme. So if you transfer to other scheme, that one is an outflow, and you have 93. Then also we had pension paid. For the pension paid, we had 382. And then we can determine we had a surplus. A surplus of an amount of 3501.25. Remember our figures, they were in millions. So that's how you present the statement of changes in net asset. So now we can present statement of net asset. So now let's present part 2, statement of net assets. The statement of net assets, we start with assets, non-current assets. And the non-current asset, we had investment property. The amount was 6616. Also, we have fixed income investment. An amount of 13,180. Also, we had equity investment. And in this case, we had both quoted and unquoted. For the quoted was an amount of 4392. The other one was 999.5. Those were the non-current assets. Then we go to the current assets. To the current assets, we had demand deposits. December demand deposits, it's more of cash and bank balances, an amount of 1173. Also, we had contribution due within that days. Within that days, which was an amount of 247. I don't think we had any other current assets. There are only two. Then directly we raise current liabilities. To the current liability, we had accrued expenses. Now, accrued expenses, the expenses which we are supposed to pay, but we have not yet paid. So for the accrued expenses, we had 12. Also, we had unpaid benefits. Was an amount of 16. Now, if you take the total assets minus liability, that's when we get the net assets. In this case, we have 26,579.5. Then we say financed by. Now we bring the equity here. We said here our equity is, we already given the accumulated fund. Yeah. Accumulated fund as at 1st April 2010, which is 23,078. That one will present the capital. Accumulated fund, which was an amount of 23,078. Then you add surplus. And this was our surplus. Our surplus was 3501.5. 3501.5. Yeah, and you have 26,579.5. So that's the balance sheet. Then there is this question for May 29. It's a theory question. We are almost finishing. May 2019. Question 3A. May 2019, question 3A. So in that question, you are to describe two types of post-employment benefit plans in accordance with IAS 19 employee benefits. Two types of employee benefits plan. And we said there are two. We said we have defined contribution plan, and also we had defined benefits plan. And we said, what are the differences? We said that for the defined contribution plan, the amount of retirement benefits paid will depend upon the amount of contribution made during the career life of the employee. Na tukasema hapo also that the employee bears the uncertainty of the amount receivable. Then the second one was defined benefit plan. We say that for the defined benefit plan, the amount payable will depend on either the average salary or the final salary, but the computation will be depend on actuarial assumptions. Good. So now that marks the end of our class. Not unless you have a question. In case you have a question, you can ask. case you have a question, you can raise your hand. Good. So have a lovely night. So that's the end of today's class.